Understanding pink sheets, the OTC market landscape. The term pink sheets has historically referred to stocks that trade over the counter, OTC, instead of on regulated public stock exchanges like the New York Stock Exchange, NYSE. While this terminology may seem outdated due to the evolution of the market, it encapsulates the notion that these companies either do not meet the listing requirements of major exchanges or choose to trade OTC to avoid the regulatory burdens and costs associated with those exchanges. What are pink sheet stocks? Pink sheet stocks are typically associated with companies at various stages of growth, including those that are too small to qualify for a stock exchange, as well as foreign companies seeking easier access to the U.S. market. Some firms may also choose to trade OTC to sidestep the complex and costly filing requirements of the Securities and Exchange Commission, SEC. Generally, stocks in the pink market fall into the category of high-risk investments, characterized by limited information availability and low regulatory oversight. Although the pink sheet designation has evolved to become OTC Markets Group, the term still enjoys common usage, especially given its historical implications in the trading of OTC securities. The structure of the OTC market. Main marketplaces. OTC Markets Group operates three distinct marketplaces for trading OTC stocks. 1. OTCQX. This tier has the most stringent requirements and offers a higher level of financial transparency. 2. OTCQB. Companies trading here must meet certain standards but are less regulated than those in the OTCQX tier. 3. Pink Market. Known for being the most speculative and least regulated environment, the pink market hosts a wide array of companies, including penny stocks, foreign entities, and fundamentally risky ventures. Electronic trading. The term pink sheets originated from the colored paper on which quotes of share prices were printed. Nowadays, the OTC trading environment is highly electronic, making it easier to trade these securities through various platforms, including online brokerages and alternative trading systems, ATS. Interdealer quotations and reporting systems. Two key interdealer quotation systems serve OTC securities. Global OTC ATS, part of the NYSE Group. OTC Link ATS, operated by OTC Markets itself. These systems help broker-dealers facilitate trades and publish bid and ask prices, thereby enhancing overall market transparency. Regulations and tiers of disclosure. Changes in regulation. The historically loose regulatory environment of the pink market has attracted scrutiny, prompting changes such as the removal of dark securities and the requirement for companies to provide public financial information. The SEC's Rule 15c2-11 amendments have enhanced disclosure requirements, making it harder for fraudulent entities to thrive. Companies now need to release financial reports, disclosure statements, and attorney letters to ensure that investors have access to essential information. Pink market tiers, current versus limited. The pink market is further divided into tiers based on compliance with disclosure requirements. Current companies. These organizations fully abide by financial disclosure rules. Pink limited companies. These firms provide minimal disclosures and risk being downgraded to the more restrictive expert market, where they cannot publicly quote prices. International and domestic requirements. For domestic companies, typical filing requirements include recent annual report, with 2 years of comparative financial statements. Quarterly financial updates. A disclosure statement outlining significant business developments. International companies have slightly different rules but must comply with similar transparency standards. Examining the pros and cons of pink market investing. Advantages. Access to capital. Provides smaller companies with a platform to raise funds by selling shares publicly. Potential for high returns. Low share prices may lead to significant gains if the company succeeds. Lower transaction costs. Companies bypass expensive listing fees associated with major exchanges. Disadvantages. Risk of fraud. the lack of stringent regulations raises dangers of inadequate or false information, making them susceptible to fraud. Thin trading. Stocks within the pink market often experience low trading volumes, complicating the buying and selling processes. Questionable disclosures. The possibility of inaccurate or outdated information can mislead investors. Noteworthy examples of pink stocks. While many companies on the pink market may seem speculative, there are reputable firms too. For instance, as of mid-June 2024, notable listings include Grayscale Ethereum Trust, ETH, a fund tracking Ethereum values. Roche Holding Ltd, RHHBY, a prominent Swiss pharmaceutical company. Nestlé SA, NSRGY, a global leader in food and beverage. Tencent Holding Ltd, Xihe, a major Chinese technology player. International firms often choose to list on the pink market for convenience, despite being established entities in their home countries. Conclusion. The pink market represents an intriguing, albeit challenging realm within the world of investing. While it provides valuable access for smaller companies seeking capital, it also harbors risks particularly associated with less stringent regulatory environments. Investors must navigate this landscape with due diligence, assessing the reliability of available information and the long-term viability of the companies they consider investing in. The evolving landscape suggests a move toward greater transparency within the OTC sector, though caution remains a prudent approach for interested investors.